Okay. Okay, so this week we had tech earnings that came out. We were expecting that. Looking at our calendar, we knew that this had grade for like important earnings. The bank started earnings reporting season around the 14th of this month, and then this week we had all the major tech stocks. Now 83% of the stock market is reported, and most of the reports are better than expected. And the tech stocks, they did really good this week because, well, we've been saying for a while that the U.S. dollar was going down, and that would be a tailwind, they call it. That would help the earnings of all the tech stocks. And you see Amazon, they actually came out with earnings last night, and they were showing they had really good revenue growth, but their cloud revenue was going down. So that's not good. That was their main driver of their company. And I'll go over that later on. But that was the one outlier of the tech group that reported. That was not as good as expected. So what happened earlier this week, we had GDP for America, and it came out 1.0. That means for the first 3 months, we had 1.3% growth or something like that. So it wasn't a recession after all. So we're not right in the middle of a recession, and it very well could be that we avoid that. Hold on for a second. Okay, so we may or may not be in a recession. So our task of predicting when the recession is going to end, and 3 months before when the recession ends, that's whenever the stock market recovers. So we don't know if it's even going to go into recession now. All right, so we're in a position right now in the S&P. Let's look at our stochastics. I update this every week. For the S&P, we're actually oversold. We're near the bottom of the oversold. Usually, when it gets down to the bottom, you buy, and when it gets to the top of the stochastics, you're overbought and you don't buy. And right now, we're like right in the middle of our trading range. We have a new uptrend that started with our momentum. There are a lot of momentum coming out of this downtrend. So now we have this higher highs, higher lows. We're right in the middle of that with a bullish, a greedy mentality for the stock market. So let's look at most of the stocks are oversold, even though we had a positive week this week. So you can see what I'm looking at is right here in all the major indexes, and we're almost at oversold. Right, we're oversold with XLC. When it gets below 20 in the stochastics, that's oversold. That's usually an indication of, it's a good time to buy. But right now we have a situation in the stock market where next week, May 3rd, the Fed is going to make an announcement, a possible interest rate announcement. And that's why I put red until we figure out what's going on there. But I think the odds in Vegas are saying we're going to have a 25 point basis hike. So that'll probably be the last one. And so right now we had a good run for all the tech stocks this week, except for Amazon, and they're probably going to give something back when there's uncertainty around what the Fed's going to do. Now, let's look at some of the things that happened this week. We're basically unchanged, even though we went up and down. Tech earnings came out. Google, Amazon, Microsoft did really good. Apple's coming up next week. So we have an indication that advertising is better than expected for the big companies, not the small ones, but the big ones. And we had cloud revenue for Microsoft was better than expected. That was good. But Amazon, they didn't meet their expectations in cloud growth. And that is the major growth portion of their company. and that's why they demanded a premium to the market for such a long time. I think that could be unwinding here. I'll go over that later on. Let me see. So in general, 80% of the S&P is reported. Most of them have reported better than expected earnings. So that's really good. And let me see. Yeah, so the Fed is near done raising interest rates. We have some uncertainty right now. Let's go back to some of our major talking points. This is Yahoo Finance, one of the best websites for stock market information. Silicon Valley Bank failed a month ago. Now it looks like we're going to have First Republic going into receivership. So that means FDIC is going to take over the bank and try to sell off things to break even, or a lot of banks are going to be starting to bid on their assets. So if you own this stock, it's going to go down to zero most likely. So this is going to cause a contraction in the economy. It's going to be that means banks that are doing good now, like J.P. Morgan and Bank of America, the big ones, they're going to be forced to tighten their lending standards. That reduces economic activity. That's like the Fed raising interest rates a quarter of a point when you have something like a failed bank. All right, so and we have Amazon that came out with their report. It says Amazon warning cautious spending across consumers. So you not only have a deceleration of growth with their cloud platform, you have cautious spending. And Amazon also said that their customers for AWS are kind of being cheap. They're like reducing the amount that they use, and that is an indication that their growth days are over. So I'm very much considering reducing my position, because one part of their business that was growing a lot is starting to slow down. You see, but Doug Cass this morning on Twitter said he's buying Amazon because he thinks, even though AWS is going down, the actual e-commerce business will do well. So we're going to review that stock later on. Let me see. Enphase Energy went down 25% this week. We're going to review that. We've been saying it's been overvalued for a while. If you compare the growth of the company to its PE ratio. And let's look at what else is happening here on the stock market. We had Warren Buffett, his company, the Berkshire Hathaway, was getting rid of some of his banks. He had a huge position of banks like USB. He had BNY Bank, Mellon Bank, and he's basically reducing his holdings in banks to only the ones without commercial real estate exposure. So people are working from home now. They're not going to use as much. Oh, hey, is there any comments? Okay. They're not making as much usage of the office space anymore. And so there's going to be probably a huge problem in the banking industry when some of these office towers renew their leases or renew their mortgages, and because no one wants to. The values of these office places in big cities are going down because they're not occupied. So that's going to be a big, and Warren Buffett saw that, and he's getting out of those kind of stocks. So I like to keep track of what he's doing, because Warren's pretty smart. He started buying up Oxy, OXY, recently, and when everyone else was selling. Let me see. What else is happening here? Okay. All right, that's all we have for our news. But we're going to watch this First Republic. If they go I think this weekend they're going to go under, and if their stock goes to zero, that could force the Fed not to raise rates anymore. Okay, let's look at the S&P 500. You can see that we're actually, this is, whenever the stock goes up and down like this, you have what's known as resistance. See right here, it's 416, right where we're at now. That's past resistance. We had that resistance here. That's February 2nd. We had it around here. That's December 1st. We had it right here. That was August 25th. And right here, June 3rd of last year. So this is basically, it's called resistance. As soon as we go back up to there, we basically have a decision to make. This is like a ceiling, and we probably need really good earnings for it to go above this spot we're at right now. And we had good earnings for the big tech stocks, but we still have more to report next week. So maybe a good report from Apple might break us out of that. But right now, most of the earnings in the S&P are forecast to be flat year over year. So there's a very good chance that our lows for the year are going to be like right here, and our highs are going to be like right here, and we're going to go back and forth through that. And I put that in our stochastics chart. So right there, where's our S&P? You can see the green lines. We're basically in this sideways pattern. If the earnings are projected to go up, then we'll break out of this. But right now they're flat. So we're going to be basically going between this high and low for the rest of the year. And the big tech stocks could break us out of this, because if they have good earnings, that's basically 1/4 of the S&P 500. So, but they've been doing really good this week. So I've been, let me see. All right, so we have unchanged 10-year and 2-year. Right now, the 2-year yield of 4.1 is, that's the market rates. So the Fed is going to have a hard time raising rates because it doesn't fight this rate right here. So let me see. We have JP Morgan said that there's a non-trivial chance of default for the United States. That is really big. If that happens, then the stock market's going to crash. And then we don't know what's going to happen. They'll probably come up with something at the last second. But JP Morgan says there's a 10% chance. That's definitely something to put on your radar as a possible black swan. That's totally irresponsible for the Congress not to raise that limit. Okay, so what else is happening here? We still have a weakening dollar. It keeps getting weaker. Tentatively, that's good for multinationals, but if it keeps going down, then we lose our buying power, and then that starts like a hyperinflation problem. Let me see. Okay, we have next week, let's look at our calendar. We have May 3rd, we have the Fed meeting. Remember the saying, buy in a rumor, sell in the news. So if we start going up until that date, chances are it'll go down as soon as they announce whatever they're announcing. So that's the same thing with earnings. If there's an expected good report from Apple and Apple goes up until the announcement, and then they announce something, the stock will go down. So that's buying the rumor, selling the news. So next Wednesday is going to be very important. Let me see. Okay, there's a big amount of money, a large amount of money going towards these money markets right now. So money's moving out of checking accounts into money markets that are paying like 4%. And Apple came out with that product that allows you to easily get 4% on your cash. So the banks like First National on the front page today, they have a huge outflow of, actually, let's go back to that report on the front page of Yahoo Finance. Okay, First National, they reported earnings on Monday, and that was one of our stocks we were watching for earnings, and they said 40% outflow of their deposits. So there's a cash crunch at this place, and it's they're basically battling. You don't get any money in your checking account for interest, and you get 4% in a money market. So that's a huge competition for stocks, and it's a big problem for banks trying to, because banks have to have money in the checking accounts to lend out to people for higher rates, and that's net interest margin. That's how banks work. Okay, let's look at. So right now we have momentum in the stock market. Let's look at our stochastics for the S&P. Okay, so we do have this momentum building here. We have higher highs, higher lows, and we're like approaching this spot right there, which is our long-term channel that we're following. Without good earnings, we're going to stay in this channel. Now let's look at some more talking points. May is always usually a good month, primarily because we have earnings that are coming out, and we have a period after May where there's nothing going on, and it's a bad for the stock market. So there's some that say sell in May and go away, and basically buy back in October. So let's see if that works this year. If the Fed raises aggressively and has a very it's called a hawkish tone, and they say we're going to raise more, then there's a very good chance we could sink into the doldrums and go into a recession. We'll see. Now, let's go back to some of our talking points. All right, so now, okay, so we're oversold, but strange, usually when we're oversold, we go to a bottom of channel, but we're right in the middle right now. So there's a chance we're going to go down more, down to here, and then that once this matches up with the bottom of this, then hopefully that'll give you a good sign that we're going to be at the bottom of our oversold conditions. You see, we're keeping track of gold as the price of as the U.S. dollar goes down. The price of gold is going up, and it's actually in an uptrend right now. And this could be one way to protect your money in a hyperinflation environment or a high inflation environment. Let's look at some of our major variables. We have oil down a little bit, 2.6%, and possibly due to predicting the stock market or the oil market predicting a lower demand because of a slowing global economy. You see, and U.S. dollar is continuing to go down. It's going down another 1% last week. Every percent it goes down, that helps the multinationals. Like we predicted the multinationals would do good because of the dollar going down, and Apple most likely is going to be a beneficiary of that next week. Let me see what else. Gold. We're going to start keeping track of gold. It's at $1,846.60 right now. So there's a very good chance as the dollar goes down, this is going to go up. So we're going to start keeping track of that. Now, we're basically towards the top of the range of Dan Now's prediction at the beginning of the year. So this 360, yeah, it's a very good chance with the, we're not in a recession right now, but we're getting into the summer doldrums, and it's a very good chance we could go down to like 360 in the bottom of that range if we have see negative interest rate information. Okay, fear and greed. We're still in greed, but we're getting more towards fear every week. So people are stopping their greediness, and it was here last week. So we're getting more towards a position of neutral to fear, and that'll line up with our stochastics. Whenever people are fearful, that'll be down here. And right now we're still pretty much greedy. Whenever there's fear in the fear greed index, and we're at the bottom of the channel, and the stochastics are down, that's the time when it's better to buy. Now, VIX is down another 6%. So this is like the pattern for the last year. So we're oversold, and the VIX is at near 52-week lows. So we're basically, people are greedy, and when the VIX is below 20, people are pedal to the metal. I'd say right now we're at a delusional spot in the stock market. Right now people are greedy, and people can't see that anything can go wrong. And that just when that happens, we get into the middle of summer, and then we start having fear in the market, possible capitulation. That could be caused by these bank failures. So we're going to keep our eyes on the other banks that are involved with this. And right now, First National could go under. And the reason why banks have problems, could affect the economy, is they can reduce the amount of money that the terminal velocity of the money going around in America. So if the banks lend less and they're more strict, there's going to be less money going in. There's going to be people fearful of having money to pay their bills, and then they're not going to buy as much, and then that leads to a recession. So
I have feeling we are reading too much into the bank failure. It seems to be localized to small, medium-sized banks. And on that Yahoo Finance web page that you opened up earlier, let's say that 70 to 80% of small business, confident they can ride out of the recession fine. Mm-hmm. So I don't see it's a problem. Big bank like Bank of America, JP Morgan, doesn't seem to be affected. They have well enough capitals.
Oh, I agree with that. I think the big banks are well positioned. They have more reserves.
And the small business on that space, one article say that 70 to 80% of small business confident they can ride out of recession with enough capital.
Oh, I didn't know that. Okay, that's a good stat to keep in mind. But 80% of all
something, I don't know.
Okay, yeah. Another stat is between 70 and 80% of all loans made to small businesses are through the regional banks, not through the big ones.
Yeah. So the small business seem to be confident they're okay with capital.
Yeah. Okay. Well, that could be good for the overall economy.
But the tightening of the policy to the small bank is no doubt coming in, and that will impact some 30% remaining of small business.
Right. So that's a big part of the economy, the small businesses, and
30% of them only or less.
Right. So that's great. I guess we're not going to have the government funding any kind of help for the businesses like COVID time, but I think businesses have been trained to work on less. Whenever when the economy shut down in the COVID lockdowns. So I think we've trained a good number of businesses how to adapt to that environment. So, but still, with the failure of some of these regional banks, the other regional banks that loan 80% of the money to these companies, they'll be more restrictive. So they won't give as much loans and as good rates as in the past. So that's whenever we're keeping track of these things, because that'll basically affect every stock we're watching. If the economy is more restrictive, then people will not buy as many iPhones, and they will not buy as many things on Amazon. So So we'll come up with the formula eventually that says, interest rates, this is how much you pay extra for stocks. And I haven't figured out that yet. Okay, so let's look at, what else can I look at today? Let's look at some of the top performers. Some of the sectors that are doing good and bad. We have oil doing the best. So oil must be look at price of oil must be going up today. Let's look at what oil. This CNN pre-market information. It basically has a list of everything that's going up and down before the market starts, and then so we have all these major movers, and at the bottom it has a list of all the commodities. So you can see a 1.6% increase in crude. We also had ExxonMobil come out with earnings today, and the big major oil companies did better than expected, even with a lower oil price. So that juiced up the whole sector, and that's why you have an outperformance in the oil stocks today. Let's look at the S&P, what's going up and down. Okay, we have, these are Mohawk, they sell carpet and stuff for houses. So it looks like the housing industry, we were talking about the housing industry way back last year as a contrary, approach to the stock market. We estimated, like last November, we said home demand will probably return when the interest rates are starting to cut. So the stock market it's basically, right now we're in April, we're in May. So it was looking to the future, when there'll be demand for housing again, which is probably around December. And all the stocks revolving around housing are starting to go up, right around April, March. So that's why whenever we were looking at all the housing stocks were undervalued way back in October and November, we looked ahead a year, we were guessing when the home demand returns, and that's basically what seems to be happening right now. You have they supply homes. What else is happening here? We have, well, that's interesting. The bank is going up when First Republic and Digital Reality. Okay, so we have First Republic going down 30. This is going to go bankrupt. This is going to go in receivership this weekend. You see, we have Mohawk, we have Charter, Zions. I don't see any theme for all this. But Stanley Black & Decker, that is a major supplier of tools for making houses. So we have houses, tools for houses. We have Mohawk Industries, they make carpet and stuff for houses. Any of these other ones do house? Okay. I don't see any other things. The ones that are doing bad, of course, we already talked about First Republic, they're going to be in receivership. T-Mobile, they must have reported bad earnings, I'm not sure. Why T-Mobile was down. Okay, Amazon is down because they didn't release their earnings and they had decelerating growth in their cloud. We have Digital Reality Trust, I never heard of them. Gilead, they're a drug company. All right, so let's look at what the NASDAQ is doing. Intel, they reported the biggest loss in their history, and it's going up. Probably because it's worse, it's better than expected. I wouldn't want to buy a company with the biggest loss in history. But I guess whenever it's you beat a lot of the companies are beating expectations, but the expectations have been lowered to a point where they can be beaten. So it's like a game that you have to follow to really understand the headlines. Okay, the ones going down the most. All high PE ratio stocks. T-Mobile, I'm not sure why. Datadog, that's a stock that has a super high PE ratio. CrowdStrike, high PE. All these have, Amazon has a high PE. So that's why it's pretty dangerous to have stocks in your portfolio with high PE ratios. We're going to go over Amazon in detail later on. Any comments? Okay, no comments.
I'm surprised American Airlines were.
I have no insight into that. Where's American Airlines?
Maybe S&P.
Oh, S&P. Oh, yeah, thanks. Okay, let's look at American Airlines going up. Where is it going up or down? There,
Second
it's up.
from bottom.
Wow. We have a lot of discretionary travel companies going up today. We have Royal Caribbean. We have American Airlines. So these are, especially if we expand this to 20, we'd have more of those. Let's see. Yeah, that's surprising. I'm not sure why. Why? You know what? If the price of oil goes up, that's usually bad for airlines. But they must have had a good earnings report. Let's do that search just right now, just for fun, and CYAL. Oh. I don't think airlines are that profitable. I mean, they're at the mercy of the price of oil, and if the oil goes up, the profitability goes down. So their PE ratio.
Some of them hedging the price rise. Some of them hedging the oil price.
Oh yeah, maybe, yeah.
I don't know which company hedge and which not, but I know some of them did.
I'm not sure how successful hedging is, because if you hedge,
and if the price go up, then you benefit.
Yeah, you benefit, but if it goes down, then you basically lost all the money you put into a hedge. So PE ratio is 71. That is huge.
Yeah,
I mean, that is
oil price been going up.
They posted a narrow earnings beat. Okay, so narrow. Let's look at what their statistics are. I'd never liked the airlines because there's a lot of competition. It's not that profitable. They traditionally had lower PE ratios because they don't grow that fast. Let's look at their PE is 70. The forward PE is 6. That's interesting. Look at that. So they're growing. I'm very interested in this. Look at this. The PEG ratio, that means they're 90% undervalued. Let's look at AAL in the growth rate. According to this company, according to Yahoo Finance, they're probably growing at 60%. That's hard to believe. Yeah, let's look at that. Let's look at AAL. Airlines just don't grow that fast unless they start charging for, to wear a hat and then they have to weigh the bag and then pay more in there. That's where they make most of their money, with these stupid fees. Let's look at. Okay, let's do the math on these. So between 22 and 23, we had a COVID push. People are getting out, and that's like super growth. So 50 divided by 2, they grew by 80%, like a lot. Now, that was because there was no growth in the pandemic. Let's go from 240 divided by 3.07 to 22%. They're growing 22% from this year to next year. Then it's 30% after that, 4.43 divided by 5.54, then 20% after that. So they're growing like 22%. But look how inconsistent their earnings are during the pandemic. That's the business isn't that durable, in a situation where you have a nationwide lockdown. The name was wanted a business then, but now they're returning to profitability. Let's look at their snapshot to see if we can see any more. All right, so the PE is like 5, and they're growing at like 30. That's interesting. So they're actually they're scheduled to grow like 20%. So they're 4 times undervalued. I have to look. I'll do a deep dive in this for next time because I'm interested in that. But traditionally, airlines don't grow that fast. They just don't. But there might be like a pent-up demand from the pandemic that's temporary. Doesn't seem like it's a permanent 20% grower like some of the other ones we're watching. It could be like a temporary COVID. I want to get out there. I'm not. I mean, end of the lockdown still.
Okay, if you look at the Southwest and it had the same picture, then that's a solid growth.
The Southwest. Let's look at that.
I don't know whether Southwest gonna have similar growth, but if they also describe the same picture, then
That's Southwest. Let's look at that. Oh, hold on. Okay, so the stock market is doing well today, even though Amazon, had that earnings from. See, find out. I wonder why it's not letting me go there. Hold on. Southwest.
LGV.
Oh, there it is. Okay, thanks. Okay, so their earnings per share PE ratio is 34. That is really high. Usually you compare a PE ratio to this S&P 500, which is around 18. So that's double the S&P. And its PEG ratio is 0.28. That means it's 1/3 the price that it should be. And it doesn't have any of our profitability metrics, though. That's one of the problems here.
I'm looking for consistent growth compared to American Airlines.
Yeah, here's American Airlines. They have a PE of 6, but their profit margin, all this information is not here. So we don't have like a fair ground to compare it against some of the ones we're following in the portfolio, like Microsoft and, Google. Okay, so I'd have to really look at this. It doesn't.
Can you calculate the growth rate?
Let's look.
That's similar to American Airlines.
Let's look. Okay, so let's look at the LUV. Okay, see if it's okay. Earnings. Okay, so definitely going up in the straight line. We had a big ramp up from 22 to 23, but we don't look at what it did in the past, only where it's going. 2.71 divided by 3.79, that's 30%. 30% from this year to next year. 3.79 divided by 4.73, 20%. 4.73 divided by 5.37, 12.
So the growth rate is consistent with American Airlines, then. So that's confirmed, right?
Yeah. So the industry is doing good. People want to get out, and they're charging enough to make a profit. But look how, for me, I look for stocks that I can buy and hold forever, and there are some business models that you can count on this kind of growth year over year, and there are some that are flaky. Like Boeing is flaky. It goes down whenever it has bad quality control. And then you see red. Oh, okay, it's positive. Okay, now it's red again. So for me, this whole industry is kind of flaky because you're unpredictable, right? But for something like Starbucks, something like, there's a steady demand for the product. And right now, people do want to get out. Maybe if we have some kind of, economic contraction where banks aren't lending, the interest rates go up, people won't be able to afford those vacations, then the flakiness makes it negative again. So we're going to start watching the airlines because this is interesting, but we'll see. We'll see if it's a robust business model. For me, I like to buy and hold because, if you hold a stock over 20 years, then you don't pay taxes on those gains. But it's really hard for me to buy this kind of stock, especially when Warren Buffett sold out of these right at the peak of the pandemic. And I follow him. If he doesn't think the business model is good enough to hold.
So he bought into airline before the pandemic.
Yeah,
He only get out when the pandemic abnormal condition occurred. So at one point he believed into into the airline industry, right? That's why he invested in there first, right?
Yeah, I don't know why he invested.
He did. He did a big investment. He only bailed out when during the pandemic.
It's really, maybe he just thought the industry was not robust enough.
Rightful decision, right? So
it was a huge mistake. I think he admitted it. It was a huge mistake.
No, I didn't.
I think during one of his annual conferences, he said, "Yeah, that was a mistake." But I think what he thinks in terms of 20 years, is the business model robust enough to grow over, like that, holding it forever? Maybe. I don't know. That was hard. That was but that's one of the reasons why I would be very cautious about a airline stock. All right, let's go to some more things I had on my list of talking points. Okay, so we have some more talking points. Okay, so as soon as Amazon released their earnings, there was a strong beat on their earnings or their revenue, but the problem was they had, they gave up massive gains because their current quarter AWS revenue is decelerating. So this is why we're going to go over Amazon right now real quick. Amazon counted on AWS for a majority of their profits. And we know, because we use cloud stuff every day, that's going to be the future of computing and companies to make money. And right now Microsoft is still growing faster now than AWS. So basically, as soon as they reported better earnings, better revenue, it went up 14%. And then it went down just as much after they said they're decelerating the AWS growth. So they're probably not going to be able to command a high PE ratio much anymore. So right now they have a PE ratio of 72. We've been going over this for a while. So at 61, and they're only growing at like 30%. So I did the calculations on Amazon. They're 40, 35, 25 growth, and so that's around 30%. So their PEG ratio is they're double the value they really should be, and they've been given this double valuation of the stock market for quite a while because they've been growing and they put all their money they make into next day shipping so they can have this moat over any other company trying to compete against them. And now they're being forced into a situation where they can't give next day shipping and they have to start cutting back in costs. So they can't really put all their profits into growing more anymore. So they have to basically do what Facebook did. In Facebook, they were putting all their money into new research in the metaverse. They were forced to cut back, and as soon as they cut back their costs, their stock went up exponentially. So this week they went up 14%. So Amazon's going to have to cut back on their spending, and then if they show growth, then the stock will be back in favor again.
Well, to begin with, cloud computing is only 14.5% of revenues total. Also, the CFO was saying that cloud AWS consumer costed in spending, not reducing dramatically, keep costed in spending. They've been doing a lot of heavy investment in AWS, and that pattern to their future earnings. So their decision are not wrong.
Yeah. Well, another good thing about AWS, they had their CEO left, Jeff Bezos, but the guy that replaced him, I think it's Andy Jassy, he was the head of the cloud department. So whatever they're doing, I'm sure they're focusing on the cloud, and they know they have the number one person that knows something about the cloud as the CEO. So I'm sure that they're eventually going to come out on top with that. So that's a good thing on their side. But I guess they're at the whim of the market right now. So right now, okay, so that there's a very good chance. What I put together here, they're growing at 30%. So the PEG ratio is 2.4. There's a very good chance they're going to have a PE ratio of 30 eventually. That's half of what they're at now. So if their stock is at 108 right now, there's a good chance it'll go down to 50 over time to be fairly valued with their growth rate. It doesn't seem like there's much growth left in the company. They've already, I don't know what they need, like more ways, more products. Like maybe if they get into healthcare or if they get into,
they're doing it right now.
They're starting it, but they're not a big. They're not a big.
Actually, they actually started it a while back. Remember, the cloud is only 14.5%, less than 15% of the total incomes, the revenues. Right. So they're 85% of orders with, growing.
Yeah.
It's not like fast because everyone else cutting costs, right?
Right.
Cutting spending, as you say.
Right. So Amazon might have to.
I'm curious on comparing the cloud revenue between AWS and Microsoft, for example.
Oh, I haven't done that yet. We'll have to do that for next time. I know Microsoft had better than expected growth.
Yeah, because they used to have almost nothing, 4%, or something, so they grow a little bit, a lot.
Right. So I think that's the key to a lot of these companies. And even Google this week posted a profit in their cloud. So every one of those companies is kind of moving towards profitability and being a major part of their company's profits. So Google has basically given away their cloud stuff just to get market share, and now they're starting to make money at it, and it could be contributing to their growth in the future.
Yeah.
So
and Microsoft had to spend the money to get our company adopted to Microsoft products.
Yeah, just like our company, we made these deals with them, and we got a good deal on the cloud, but
Microsoft actually spent money on us,
right,
to get us to adopt to their clouds.
Yeah, right.
Whereas Amazon actually make money from us, so that's two different pictures, right?
Yeah, you're right, absolutely. So I guess it's all about market share, and when you make these deals with the companies like Microsoft did with our company, that you get a portion of market share for 10 years guaranteed, and if you do that with enough companies, then you start having pricing power. And I think what we learned this week is pricing power is very important. A lot of the big tech companies have pricing power, and that's why you can see companies like Amazon, not like Google and Microsoft, still have profits in the middle of possibly a recession, and how they can continue to have a PE ratio of like 28 when the stock market has 18 PE.
When you say pricing power, you mean the ability to increase or the price as well, right? Amazon had that. Amazon had that. Microsoft doesn't. Google doesn't.
Well, it depends on what you're talking about, because
cloud computing.
Cloud computing, yes, you're right about that. But Microsoft, they can demand whatever they want for Office subscription.
No, for cloud they cannot, because they actually spend money on us to get us adopted to their technology.
Well, I agree with that. But for their other products, which they have monopolies in, they have pricing power.
Yeah, but we are talking about cloud computing.
Oh yeah, right. So But in general, pricing power is the theme for this week. That, like Coca-Cola, we were talking about last week. Coca-Cola and Pepsi both reported earnings and claimed that they raised prices and did not affect their demand. So it's the companies that were able to have pricing power and hold their prices or raise that did good this earnings season. Okay, so we already talked about this. Okay, I'm going to talk about Enphase Energy. This is one of Mark Oppenheim's favorite stocks. And we were talking about this for quite a while, about it being overvalued. We looked at the growth rate, and we tried to match that to its PE ratio. And still, right now, I did the calculations. This stock went down 24% this week in
Wow.
one day. Yeah, that is pretty big. They basically had an earnings report, and it wasn't as good as expected. They're growing their earnings around, let's say, 27%. So even with a drop of 24% this week, their PEG ratio is still 1.3, which is 30% overvalued. So there's a very good chance that they could go down another 30% until they're fair valued. They're about fairly valued. So I looked at some of their statistics. Their PE is currently 36. And so if they're growing at 27 average, let's say 20, then their PEG ratio is 1.3. So according to Yahoo, they're 12% overvalued now. But they do have good profit margins and return on equity. That is much better than we expected. And the problem, they're actually affected by interest rates, because a lot of times when you put these installations onto your house, as long as interest rates are so high, we're not saying that the numbers are going to return back to where they were. Demand will unleash only when the interest rates are back to normal. So as the interest rates go up, the demand for the product goes down, because it doesn't make sense to install this and to use their software if it doesn't make sense for your situation if you're not going to make money over time using their product. So they rely a lot on financing for
Are they
installing.
in energy or semiconductor?
They're involved in, let's say, rooftop installations of solar, and then energy harvesting, selling back to the power company, that kind of product.
I'm surprised because Scott Ray lists them as information technology, semiconductor, and semiconductor equipment.
Well, they do software for managing the solar power, and
Okay.
so for instance, you'd get a report at the end of every month how much money you sold, how much power you sold back to the power company, and all that kind of thing, and they manage the power on your rooftop. So that's why they're kind of listed as a tech company. I guess the solar power cells on your roof are considered tech oriented. Okay, so I mentioned about First Republic is probably going to be in conservatorship. Well, FDIC will take over the company most likely, and that's going to make the economy less robust, and it could reduce the amount of lending that happens, and that affects the amount of iPhones people buy, how much they search on the internet, all kind of ripples from that. We have enough of these that could cause a crisis and a 20% downdraft in the stock market. But right now it's pretty much contained. I'm going to review one quick thing before we finish today. What happens if you have a stock market crash? One of the worst things you can do if the stock market crashes is to sell everything, because basically you don't want to lose what you have. But a lot of times it just bounces back right after a major crash. And then you try to get back in, then you're out 30% instead of 10%. And then you have to pay capital gains if you have any actual gains in that. Okay, so basically, whenever there's a crash, you look at the long-term business model. You say, is this affected by this, maybe a banking crisis, or is Microsoft going to be affected? How are the stocks that I'm following in my portfolio really affected by this? And you have to see the fair values of the stocks too. Like what we're doing with Enphase, we're trying to predict the fair value of the stock. So you divide that fair value by the current price by the PEG ratio. That gives you the price it should be trading at. And a lot of times during a sell-off, that's the price that it'll go down to. Like Facebook, it was growing at 14%, and it went down to the PE ratio of 1, back, $100 a share, and that's where it's fair value. It's a fairly valued. So during the times of panic, we have a bunch of stocks we're following. You just have to make 3 decisions. Well, when do you sell? And when do you get back in, if ever? And what do you buy in replacement of what you just sold? And so all in all, it's really difficult. In doing all this, you have to take into account 20%. If you have any gains, you have to pay 20%. So you're already losing 20% if you have any gains. Then you have to buy something that's 20% off and buy it again in order to be back where you were when you sold it. So it really doesn't make much sense to sell when there's a market crash, unless there's a really good reason.